Good afternoon, everyone. We are gathered at Consensus at a fascinating, if slightly painful moment in the digital asset market space. Bitcoin is currently under 70,000, and for the first time, we have regulated ETF infrastructure sitting right in the splash zone. But before we dive into the wreckage of that, let's just do some brief intros for the audience and just a 30-second vibe check. What do you consider to be the biggest driver of the ETF surge we saw leading up to 2026? We can just start down the line.
Okay, I'll start first. My name is Yi, and I'm CIO of CSOP. And in 2026, I think we are the largest ETF issuer in Hong Kong. We are the first one launched the Bitcoin future-based ETF in Hong Kong. And within this year, I think there's a lot of discussions about tokenizations of ETF products. So we are quite actively working on it. And we do believe that if you're talking about future format of a financial product, token might be a better format compared to ETF format. So that's the view we have. Maybe take us several years, we don't know. But actually, Hong Kong is allowing for tokenization of real-world assets. That's a good starting point of the regulatory world. So that's my view. Maybe for this year, there's a lot of like RWA, tokenized money market fund, tokenized funds are going to happen in Hong Kong and globally as well. Yeah, thanks.
Tim Shea. I am a managing director at Jefferies. I head up our digital assets investment banking franchise globally. To answer the question on what I think led to the run-up in ETFs, and I think crypto ETFs specifically, is ease of access, right? Because it opened up a vehicle that gave access to people that didn't necessarily know how to go and open up an account on a crypto exchange, the ability to transact in their traditional brokerage account to gain exposure to an asset class that they maybe had an interest in but didn't know how to access it previously. It can also be distributed through a number of different channels, through advisors, other platforms. And I think that it's that as well as the ease of use for institutions that really led to the surge in AUM, really.
Marc Jansen, Co-Chief Trading Officer at Flow Traders, Global Head of Trading. We're active for about 2 decades in ETFs. We're globally one of the main market makers there. And since 2017, also active in digital assets. But yeah, from that perspective, fully agree on the access ETFs bring. It drives extra demand, and that's also what drives this surge, in my opinion.
Yeah, I'm Anton Katz. I'm the co-founder and CEO of Talos. We're the largest provider of trading technology to digital assets, primarily for larger institutions. We play a pretty big role these days in the ETF because we are powering quite a lot of underlying trading for the ETFs. We are facilitating the Bitcoin and the Ethereum and quite a few other assets trading. So we have a front seat to what's happening on the ETF domain. When you're asking like whether there was a surge in ETF and the demand, I mean, honestly, it's a little bit of a lopsided question. I think that actually there was quite a lot of demand already for quite some time, and we just couldn't get the ETF approved on some of the major stages. The ETFs in Europe were approved, and we started to seeing some demand. And ultimately, the regulation in the United States caught up and approved the ETF there. Mm-hmm. And as a result of that, we've seen a huge acceleration in terms of demand and access. And I do agree with Tim. A lot of it is people are looking for, an easy vehicle, an easy tool to access. Being able to, not worry about custody, not worry about some of the operational burden that you kind of like have to take into account when you're interacting with digital assets. So it kind of opened up the door to quite a lot more retail investors. But at the same time, it also opened the door to institutional investors that can finally use the vehicle to plug into their existing risk tools, existing trading infrastructure, existing reporting infrastructure, all those kind of things that they kind of need to rethink when they're interacting natively with digital assets.
Great. Can I get the first slide, please? So yesterday, Coindesk reported that U.S. Bitcoin ETFs registered back-to-back inflows for the first time in a month. And despite Bitcoin being down over 40% from its October high last year, total BTC held in ETFs only dipped 6%. So Timothy, I'm going to kick this to you first. Did the ETF market pass its first real stress test?
I think it did, because what you saw is as the prices went down, as usually happens when prices go down, people started to sell, but it wasn't a fire sale. The system's all held in place, and once asset prices reached the low 60s and Bitcoin bounced off of that level, you saw people start to buy again, as you usually see when things start to go up. So I don't think that anything unexpected happened there, and I think that, yes, passed the stress test.
Okay. So Anton, since you were bringing up regulation, let's talk about the hurdles with that. So even with Trump's regulatory tailwinds, we're still waiting on that comprehensive market structure bill in the States. Is the lack of clear federal regulation the biggest blocker for adoption?
I would say that it's definitely a major one for quite a lot of institutions. I think that, the difference between 2026 and 2022 is that there was quite a lot of headlines in 2022 generated by the different organizations saying, we're going to be participating in this market, we're going to be adopting. Today, I think we're seeing a little bit more of a muted approach from the media side. So there's not as many of these big banners, we're in digital assets, we're doing this, but actually behind the scenes, because those are our clients, we've seen a lot more activity these days than we've seen in 2022. In 2025, our clients the new clientele has completely lopsided towards, so we have more traditional institutional clients in 2025 than in the previous years, which is kind of like seeing this. So yes, of course, a lot of them are looking to see what's happening with the Clarity Bill. They're looking to see what's happening with the regulators in terms of bifurcation of regulation, right? What is the SEC going to be responsible for? What is the CFTC is going to be responsible for? And I honestly think we're very, very close to that. So a lot of institutions right now are operating and pushing forward as if we are about to see much more clarity there. But yes, regulation and policy has been one of the larger barriers for this industry for quite some time.
Okay. Can I get the next slide, please? So on the flip side of hurdles, let's look at the banking seal of approval. Last October, Coindesk reported that JP Morgan began accepting spot BTC ETFs and collateral for loans. Does that move the ETFs officially into away from being end the speculative asset debate? Anyone? You want to take it, Marc?
Yeah, I don't necessarily agree with let's say that question in particular, because they're allowing ETFs as a pledge, not the spot itself. It's mainly the ETF.
Okay.
So it's mainly the vehicle itself, which they allow. They already allow multiple ETFs as collateral, and also a lot of other products. I think it is a small step that they also allow Bitcoin, which does improve capital requirements, also from different participants. But I wouldn't go as far as that, this is the major step that spot Bitcoin is becoming the new gold standard.
Okay. Anton, do you agree with Marc's conservative
Sometimes I agree with Marc.
approach?
But it's
Luckily, not always.
Not always. Yeah, look, I think it's in our industry, it's always been a little bit of crawl before you walk, before you run. I do see this as an interesting step. Is it a huge, major step? Probably not not to an enormous degree, but this does start to say, look, before that, in primes and in some of the banks, crypto ETFs specifically were not accepted as collateral. That is actually a huge deal. They were specifically excluded as collateral. So if you held assets in crypto ETFs, you might not enjoy some of the same margins that you would enjoy with a prime. Today, that's changing. That's actually a very, very positive thing. Having said that, if you actually look at the details, it's an awesome headline, but if you look at the details, there's still quite a lot of issues there, right? We are looking at haircuts that are significantly higher than the haircuts we have on treasuries, for instance, as collateral. But if you look into the future, I think that's kind of, you need to get comfort, you need to get your risk systems in order. But we are also seeing that a lot of the institutions that are starting to talk about lending assets against direct crypto collateral. So against crypto, against Bitcoin, against Ethereum, also a step in the right direction. So I don't think we're there yet, but this is the entire point, is to have those tools in the entire financial economic system.
I do agree it's baby steps. But collateral-wise, we're definitely not there yet. We're paying as a market maker way higher capital than other ETFs. So for cryptos, especially if we post our collateral at banks, our leverage is very small in these ETFs. And that also doesn't help with reducing the volatility in the ETF versus the underlying.
Yeah, one thing that I would say here that you need to keep in mind is that an ETF trades as an equity, so this didn't require anything in terms of infrastructure changes to enable this. It was just simply a change in view. Whereas accepting actual collateral of Bitcoin or ETH or any other digital asset for that matter, that would require real infrastructure change. And I think that that would be a bigger step than simply allowing Bitcoin or Ether as collateral.
Yeah.
ETF, Bitcoin or Ether as collateral.
Yeah, I think for the infrastructure side, we are the largest, maybe one of the largest OTC counterparty with a lot of banks on the street. So different banks have a different approach. We do see that the testing internally, for example, adopting like blockchain technology and build up the internal tokens to allow either you're claiming or is bank transfers, cash movements. We're talking about a lot of hurdles when we transfer collaterals. Regulatory-wise, I think as a bank, they have a different layer of regulation as well. So even though we can say JP Morgan would like to take it, but what about Basel? What about MiFi? All those guys going to define whether even stablecoin, we never heard about, they can accept stablecoin as a collateral, right? So there are several steps that requires different layer of regulation working together, allow those bigger players within TradFi system to accept as a collateral. But collateral itself, they are adopting a blockchain technology. They are trying. They are working on it. Hopefully one day they can take it.
Just one more point on this. Do you all consider Bitcoin now sitting on the institutional balance sheet alongside treasuries and gold?
For our clients, yeah, they probably, especially for high net wealth, during the last several years, I think it doesn't matter if we're talking about Hong Kong or Singapore or other regions clients, they do have interest to put a certain percentage of their wealth into crypto investments, especially for Bitcoin. And we do see some banks offering this kind of products, and we as ETF issuer offering a Bitcoin ETF. But what those guys trying to do is just building up a bridge between TradFi and the DeFi world. Yeah. So I think both sides see opportunities out there, and both sides would like to participate a little bit for the demands we are talking about. From institution side, I think from US definitely is moving. Yeah, from local side, because we are just allowing the Bitcoin ETF and either future-based or the physical formats in the market. However, based on the turnover and flows, we don't see too much change in terms of adoption compared with US Treasury and gold. US, we do see that happens, yeah.
Do any of you want to touch on that briefly?
Yeah, I think that if you're to think about digital assets going into treasuries of companies, if you're talking about Bitcoin as an example, I think that it depends on the company. I think that if you're talking about stable coins going into treasury, there's some real utility to have that as opposed to bank accounts because of the ability to transfer money between entities 24/7 over weekends with lower fees, right? And that's something that has real value to companies, but that I view as something that's a different decision than what is the actual allocation of the assets within the treasury.
We see from globally, from our, we have over 2,000 counterparties, and from there we do see that there are some early adopters. So there's definitely part of them who are allocating parts of their balance sheets towards crypto, and then it's almost solely Bitcoin, to be fair. But we have a very long way to go in adoption. The majority isn't allocating, to be fair.
Yeah, I think that that's totally fair. There's definitely demand, and there's definitely first movers into that space, trying to figure out how to diversify the treasury that they're holding, and it is really a smaller set of the institutions. I think the bigger conversation right now is about how that treasury interacts with digital assets, as we're seeing capital markets starting to migrate towards digital assets. That's much bigger conversation.
Right.
And again, to Tim's point, like whether it's access, whether it's mobility of those assets, 24/7 nature of those assets, that's becoming very, very attractive to the customers.
Okay. So we focused heavily on the U.S. narrative, but there's a disconnect across the pond, arguably. So Yi, I'll start with you. Before you were at CSOP,
Yeah.
you were at a London firm,
Yeah.
and Marc as well. And so there we have Micah in Europe, active in Europe, and the UK regime is finally warming up. Yet European retail adoption is still lagging behind compared to the U.S. frenzy. Is there like a specific cultural or regulatory shift that needs to occur, or is it more of a marketing question?
Yeah.
Or
Yeah, from my last job experience with serving pension funds, sovereign funds, insurance companies as an investment consultant. So one of the frustrating points I found that is European market is so fragmented, and not one product can serve for all, and the different countries. You may have a UK regulation, slightly different from the Holland, different from the German or France. You have the UCITS formats, so just passporting all the investment vehicles across the region. But end of the day, different countries, regulations play heavy roles on top of Europe. The joke about US, China, European is leading on the regulation side. So that's a matter of a fact to large adoptions and also the popularity of the crypto products to be as popular as in US. I think that's one of the driver. But I moved back to Hong Kong for years, so maybe those guys have more updates from the European situation right now.
Yeah, definitely. So I think the first part is European retail is vastly different in their risk tolerance towards the US. So a lot of Europeans have a lot of their savings just in their bank account and sitting on cash. And then I think another big difference is that a lot of Europeans have a lot of wealth in their pensions, and a lot of European pensions aren't allocating money towards crypto yet. So that is one big difference. I think another big difference between the US market and the European market is the US market, the rails of ETFs is far further set up than in European countries. European countries or European retail is interacting with financial markets a lot via their banks, and those banks usually offer their own products instead of ETFs. So there you also do see a big difference where banks in Europe, I believe, have quite some difficulties with the Basel rules. So in their cost of capital is very high if they have exposure towards crypto assets. So that's also not helping in Europe on the adoption towards crypto.
Okay. Anton, did you want to add anything to that, or?
No, I mean, I think Marc knows the domain really, really well, right?
Okay.
I think you look at the composition, the history there is that Europe was the first to launch those exchange-traded vehicles, and everybody was super excited about it, and basically, not a lot has happened. There was an uptick, but there wasn't a very, very meaningful uptick. And once we saw this launch in the United States, then we've seen a very meaningful uptick. And it's, again, it's enough to look at the composition of the investors in those, being predominantly retail for the US ETFs, and the wealth management aspect of the institutional portion there just tells you that it is part of the education, it's part of the machinery, but it's really the people that are getting in Asia and in the United States are they have a different attitude towards risk, and I think this is just a lot more conservative story in Europe.
Okay.
Yeah.
Okay, so let's look forward, because we aren't just talking about buying Bitcoin on an exchange anymore. We're talking about tokenized ETFs and altcoin funds. So in terms of tokenization, how soon will on-chain delivery of ETFs, where shares themselves are tokens become a standard requirement for an institutional portfolio. Tim, do you want to?
Yeah, I'm happy to start with that. I think that similar to the way that ETFs bring accessibility to crypto to traditional investors, I think that bringing ETFs of asset classes outside of crypto brings accessibility of those types of products to the crypto world. So if you're to think about somebody that is in a non-US, non-European jurisdiction that wants to buy the S&P on a weekend, the way that they're going to be able to do that is by transacting on-chain. That's something that they wouldn't be able to do today. So I think that it's something that, from an accessibility standpoint, is good. It also brings increased efficiency where you eliminate a lot of the middlemen in the system. They're often referred to as rent collectors. And that cost savings can then be passed on to the ultimate user of the product.
So you see a demand there. It's not just tech for tech's sake. The token.
I think it depends on the type of asset that is being tokenized. So I don't think that, as an example, it would make sense to tokenize a Bitcoin ETF because you could just buy the Bitcoin directly. But if you're talking about tokenizing an S&P ETF, then I think that that can make some sense.
Okay. Yeah, I would agree there. So we were active from almost the very start of ETFs, and we saw that industry grow. And what we believe will happen on the tokenization side is that will, just like the ETF, be its own new product. We see the growth patterns to be quite similar, and it's also adding, on top of the ETF, some additional use case like the 24/7, direct settlements, fractionalization. The longer term, probably programmability as well, but at the moment there are not that many use cases yet, but I believe they will come very soon. Well, if you look back in the ETF, they did 20 years ago almost the same. They made access towards index tracking a lot easier for people, and I think that innovation, which we saw in the ETF space, will happen on the tokenized real-world assets as well in the longer-term future.
Yeah, I think back to follow-up is there's a lot of jobs that requires a flow trader as a market maker to do. So if you have, for example, tokenized S&P, it's a good thing we can trade 24 hours, but end of the day, both market, doesn't matter you are S&P ETF or S&P ETF token, it requires liquidity. People would like to trade, and you need to have someone to quote on the market and be able to let market maker to quote on the market. You need to have the fluent mechanism on the back end, how to mint your coin, how to redeem your ETF shares. If you have ETF shares, can I convert into token? That can be supported 24 hours. We know that a lot of institutions setting up in the way that they have the digital arm, they have the traditional finance arm, but this kind of token requires both arms build up a bridge, link close to balance sheet together. Then you can take the arbitrage opportunities, right? So I think those guys will be more than happy to see a lot of trading activities happening on the, say, crypto exchange, digital exchange, but from the back end, there's a lot of differences, gaps that you need to fill in to make the whole entire process being smooth enough. So you're able to gather in all the stakeholders, not only I providing a very fancy token. The token is AI investment strategy driven, or is representing NVIDIA or SK Hynix, which we have. But if we put that token on the chain, does it gonna attracting decent amount of demand? The demand is coming from retail investors, arbitrager, or speculators, whoever. Yeah, we are welcome, but we need the infrastructure and the backend stakeholder happy about the whole flow. Yeah.
But so in terms of the product innovations, I'm sort of getting the sense that you guys don't think it's a blocker for retail investors. It's sort of answering the first question I asked, where the answer is ease of access, and you look at the technology as being the entry point. Is sort of you're all agreeing.
Yeah. I mean, it is completely ease of access because traditional ETFs are built on old infrastructure, right? So if you're putting Bitcoin into that vehicle, you're putting new infrastructure into old infrastructure so that users of the old infrastructure can access something that's new the old way, right? So that is all that it is. When we're starting to talk to the last conversation on tokenizing ETFs that offer other types of products, so that would be, again, back to the S&P example, that is, again, that is bringing an existing product onto new infrastructure, which is a little bit of a different thing than bringing a new product onto old infrastructure.
So I think that the ease of access and distribution is a part of the conversation, and I think it's a totally reasonable first step, just giving people access. And we see this all the time. You know, we're now seeing quite a lot of our clients across the board asking for more and more tokenization. ETFs are, you know, we're still in the equities world. There's a bigger, broader discussion here of how do digital assets and how does crypto collide with traditional assets. And if you see right now, like a lot of the liquidity providers, a lot of the exchanges are starting to add the traditional assets. And so that's kind of like the first step. The second step is adding those in a tokenized form. But really, the interesting thing is if you take that to the extreme and you say, like, okay, what happens once we have these assets tokenized? It's not just the ease of access and the ease of use. It's the ability to plug into infrastructure that is brand new, infrastructure that includes services that we didn't have in capital markets. If you're able to take your equity that is a token and you're able to put it in a lending pool and borrow assets against it, and then you can leverage your trade, and all of that can be done within 10 minutes. That's not capabilities that we have in capital markets today, not on the retail side and definitely not on the institutional side. Yeah. So a lot of the promise here is actually, like, you know, you're starting to migrate to this new infrastructure. The distribution is going to be just the first inning. There's a lot more behind it.
Yeah. Okay, we have less than 2 minutes left, but putting aside one final rapid fire question, putting aside the current dip in the Bitcoin price, what is one big bold prediction for ETF trend, the ETF market or trends look in the year ahead?
Maybe reversing.
Go down the line.
Yeah, we have 1 minute. Go.
I think, as I mentioned at the very beginning, so in Hong Kong, the tokenization is happening. So ETF is going to be, whether it's a next format of a security offering, I don't know. Yeah, but we would like to try and how to merging like ETF offerings together with token. Yeah.
Great, Tim.
Yeah, I think it's adoption in the advisor distribution channel, and as recommended allocations to crypto increase and usage of the ETF product, I think that will drive AUM higher.
Yeah.
I think within 1 to 2 years, we will see ETFs being tokenized and really tradable on a 24/7 basis.
Yeah. I think, so I agree with a lot of what I said. I think that some of the innovation that we're going to see is that ETFs are going to move away from just looking at a single asset. We're going to start looking at multi-token ETFs. That's starting to happen now. I think the adoption is going to be gradual there. And ultimately, I think that we are going to, within the next 2 years, see ETFs that combine assets from the crypto world and the traditional world. And that will be an interesting combination of investment diversification.
Great. We look forward to that. Thank you for the big discussion in the short amount of time.
Thank you.
Thank you. Thank you, guys. Have a good rest of your consensus.